It is kind of hard to think about this stuff sometimes. All right, so if Mango Tango was eliminated, what would happen to the profitability for the entire business of Fruity Sorbet? Now, a reminder, they can't get rid of this equipment depreciation. It's still going to be there, and they can't get rid of this allocated facility sustaining cost because it would just go to another line. So Fruity Sorbet, the company would still incur those costs no matter what. So it would go to another product line. So product line. All right, so if they got rid of the entire Mango Tango line, they would lose out $500,000 revenue and the $420,000 of cost. So they would lose out on $80,000 of profit. Isn't that weird? You're like, but Ms. Barron, you just told me these other things. I know, but those things would still be there. It would just go to another product line. The only relevant things here is what they would lose out on if they got rid of the segment for the Mango Tango. So if they were to get rid of it, they lose out on $80,000 profit, which goes towards covering these other costs. Bottom line, they're in a net loss for this line, but these things could go to another product line. These are unavoidable. The profit of $80,000 would be lost by getting rid of Mango Tango. So coming back up here, why did Sears Building stick around for so long? Well, to keep the doors open, even though they're not profitable. Some of these buildings, the individual stores, they contributed enough, kind of like Mango Tango, so that they covered some of those unavoidable costs. Otherwise, they would, if this was a Sears situation, I know this is a stretch, they would have $125,000 they still have to cover. They would be covering things like the building they leased, or maybe they have lawyers still on retention that they need for their business. They had some unavoidable costs. And so because we're keeping the doors open, even though they're not profitable, it's able to cover some of those unavoidable costs. All right, now let's look at it as several segments combined into a whole. Before I read any of this, I can kind of look at that and go, oh, look at the total. Look at that, $130,000. They're doing good, right? Yeah, okay, they're profitable. Chuck's Furniture Store has 3 departments. They've got the bedroom furniture, the living room furniture, and the dining room furniture. And all the departments are housed in a single building, each occupying a full floor. So we are using the entire building, no matter what. We've got the whole building to pay for. Each department has its own manager. Recently, the dining room department has been suffering a loss. So they're going, oh man, look at that. That dining room, they're doing poorly. We should just axe them, get rid of them, right? Last year's income statements follow. Determine whether to eliminate the dining room furniture department by preparing the income statement assuming the dining room furniture department is eliminated. So $130,000, we're doing good, but we would probably do better, right, if we got rid of the dining room furniture? They're bringing us down, don't you think? Let's go through here and figure out which of these costs are unavoidable. Of course, if we get rid of the dining room furniture, we're not going to get any of those sales. That's relevant to us, and those are avoidable. The cost of the goods sold, if we don't have that department, we don't have cost of goods sold for that department, so that's avoidable. That goes with our gross margin. Department salary manager, well, if we don't have a department, we don't have a manager. We can avoid it. The rent for the building, all right. Now, it told us that we have the entire building. They're all in one building. So even if we don't have this floor being used, we still have the whole building we're paying for. We say that that is an unavoidable cost. The rent cannot be avoided. The $40,000 cannot be avoided because we're using the whole building. Building utilities. Now, I know you might say to me, you have the lights on up there in that 3rd story. You won't have them on. Yeah, but typically our rent's going to be things like heating the building, things like that. That's really where the cost is going to come from. Again, we have the whole building we've got to pay for. So even though we're not using the dining room furniture floor, we probably still have building utilities similar to what we currently have. And we've got to allocate that to the other ones. So our utilities, probably unavoidable. General business expenses. I don't know what this means, but just tell me it's general business. So I'm going to assume here those kind of things, like maybe you have I don't know, cleaner, or maybe you've got some insurance on the building, general stuff. That does not indicate to me that this would go away if we got rid of the dining room furniture. General tells me that's probably shared amongst the 3 divisions. I also see that it's equally shared. So that's kind of a clue to me too. They probably just allocated it. Unavoidable, the general allocated. And sometimes you're going to see this like a facility level, they'll call it facility level, of $30,000. These are things we can't avoid. If we got rid of our dining room furniture, great. We get rid of its profit. We get rid of its, its gross margin. We get rid of its manager, but we still got some other costs that the entire business is still going to incur. All right. Now, I'm going to go ahead and ask you to pause here. Of course, it's going to take me some time anyway to write it all out. Recreate this entire income statement down here with the dining room furniture eliminated. Keep in mind that these costs have to get reallocated to the other departments because we cannot avoid them. So go ahead and pause it, see if you can write it all out. I'm just going to write down everything I see here in that column, cost of goods sold, and create a new income statement. I'll come back and talk through it. Okay, so hopefully you got your table filled out. Let's look at what is going on. So as I mentioned, okay, so we've got those unavoidable costs. The rent will still be $120,000 for the whole business. The building utilities will still be about $60,000, and our general business will still be $90,000. These are unavoidable. So here I am down here. I am showing that those costs are still unavoidable for the entire business. I've allocated what was there for the dining room furniture, the $40,000. I've divided it between the two departments. 40,000 divided by 2, and I added it to what was there before. So living room furniture before had 40,000, I got 20,000 extra. Same with my building utilities. I had 20,000 in dining room, and I allocated those 10,000 extra to each of those divisions. So you'll see those where the numbers are coming from. So at the end of the elimination, we've got $80,000 total net income for this entire business. Did they eliminate the dining room furniture department? No, they shouldn't. They were at $130,000. They had $130,000 in our net income. Why would they get rid of it if their net income would be $80,000? Why would they get rid of it? They had $130,000 net income. It would be $80,000 if eliminated. They wouldn't want to go down. That's not the point. The point is they were worried that it was a net loss for that segment. But as we looked at what's avoidable and unavoidable, we realized it's really bringing in a positive amount, positive by 100,000 margin, minus our salary, $50,000 of our avoidable extra profit to go towards these other costs. And so that's where you get your difference of $50,000. So yes, make sure when you're going through these, you keep in mind what's relevant and irrelevant. And as always, reach out to me if you've got questions. These are weird. You've got to kind of wrap your mind around it as far as what can we avoid and not avoid. But I think you'll get the hang of it if you do your practice problems and do the problems in the back of your chapter of your book. But always reach out if you need any help. I'd be happy to help you.